So then the question is, can these fees be said to be effectively connected with the permanent establishment? Actual wording is, and the right property or contract in respect of which the fees for technical services are paid is effectively connected with such permanent establishment. So is it effectively connected? It should be, because it's a contract for the construction, without that you not have got it. And therefore Article 12 won't apply. But doesn't mean it's exempt, doesn't mean it's exempt. You still have to test for other articles, and now say Article 7, it is still business income. Maybe FTF, but it is still business income. Only one subcategory of business income. If it falls outside 12, it will fall into 7. And what does 7 say? It says that income attributable to a P will be taxable. The slight difference in the wording. Once effectively connected in 12, this says attributable. Now, is it attributable to the P? It's not done by the P. So we can try and say it's not attributable to the P. And therefore, the Article 7 is exempt from tax.
In case of Excel, the same argument was.
Yeah, but it's not exactly correct. Yes.
But I have another point in case of naval ignite. As held, the dominant character is supply, even though there is a designing engineering.
Yes.
Ultimately, is covered by exclusion to 917.
Yes.
Hence, it is not taxable. The whole transaction is not taxable.
In construction project.
Yeah. Like it was a supply for power equipment, where they were saying we do contract supply and services. In offshore supply and service, there was also engineering and design payment.
So was it local construction also?
Yeah, they were also there.
There was.
It was an EPC contract. And then the Madras High Court has ruled in Naval Ignite that design engineering is a dominant part of the purchase. Only for certain purpose you have split, and hence it is also part of supply.
Then you run the risk of the entire contract being clubbed all together. Then.
No, the supply is done outside India. The economic activity is outside India. So why will India tax it?
Yeah, true. Yeah, that's possible.
So that is a very good judgment of Naval Ignite.
Yes.
Where they have given what is 917 and how we should exclude for such contract.
Yeah, that's also possible. It's part of a total contract. So always opportunities are there. In spite of Ashapura, there are still opportunities, so we should not be disheartened when something goes again. Find something else. It's a very complex treaty. It's something that always be found. That was 10. Now 11.2. Fees for a foreign conference. And foreign company has no permanent establishment in India. Now first question, is this payment taxable in India? You go for a tax conference and pay fees for the conference, for participating and listening to the people, will it be taxable in India? No, 917, technical service fees. This is not considered as service fees. There's some controversy on this, but let's assume it's a conference like exhibition or something, where there is no FTS element. Then that clearly is not taxable in India. But the question is whether the Indian company has to obtain a tax residence certificate from the foreign company. In this case, the payment is not taxable under the Income Tax Act itself. The question then is whether TRC is required. So it shouldn't be required. And is PAN required? No, yeah, for taxable is not required. So only for rate of withholding that might be required the PAN. So PAN also not required.
Coming to 11.3. 11.3. Here the issue is A purchases house from B in June 2016. A and B are both in India. In July, the very next month, B leaves India for employment and will become a non-resident by March 16. By March 17, he would have become a non-resident. The question is, if A has not deducted any tax at source, was he liable in the first place? So yes, the answer is no, because as far as 194(1)(a) is concerned, the amount is less than 50 lakhs, so the question of TDS would not arise. As far as 195 is concerned, the obligation to deduct tax arises at the time when you are making the payment or at the time of credit. So when you are making the payment in June, B is a resident in India. It's a separate issue that during the financial, an issue may arise that residential status is for the financial year or for the assessment year. So for that particular AY 17-18, he is a non-resident. And can an officer say that you made payment to a non-resident and you should have deducted tax? So there have been cases, there is a famous Latin maxim which says lex non cogit ad impossibilia, which is the law cannot expect you to do the impossible. Now, I would have never known in June that he's going to become a non-resident. There are a number of decisions where there was a software amendment in our Act, and they held that when you made the payment, though the amendment was a retrospective effect, when you made the payment, at that point of time it was not taxable. However, the recipient may be taxable by a retrospective amendment, but you can't hold the deductor liable for non-deduction of tax for a retrospective amendment or something which is not in his control. So the law cannot expect you to do the impossible, and therefore in this case, though he becomes a non-resident, he would not be, there would be no obligation on A to deduct tax. Now we come to 11.4. 11.4 is a case where H, a non-resident tax resident of UK, sold property in India. The purchaser did not withhold tax at source from payment to her, and this is how the funds were received. So the sale consideration is 1,000. The long-term capital gain after cost of acquisition and index cost of acquisition is 500. The tax on 500 is 103, and the proposed investment in the new house property is 600. So if the investment is made in 600, there will be no tax liability by virtue of section 54. Now the question is, this is a little tricky one. Now she, that is, this is the one who is receiving the money, who has sold the property, not the one who is buying the property. She now proposes to remit funds to UK. The bank is requesting for form 15CA and 15CB. She intends to remit part of the funds from a bank account in India to her bank account in UK. So at least here in the facts, it is not the situation where A is making payment to B, but B itself is transferring funds from one account to the other. And practically when you go to the RBI, when you go to the authorized dealer, they say, no, you get me this form 15C and 15CB from the CE. So I will answer the second part a little later. Let's assume if it was from A to B, how would these questions be answered? So will a CA issue, now I'm saying from the purchaser's perspective, who is making the payment. Will a CA issue a certificate under 15CB on the basis that there is no tax because an investment is going to be made? I don't think anybody would take a chance, because that investment eventually may, for whatever reason, may not happen. Would the answer be different had she purchased the new house? Yes, because then the investment has happened. Can part remittance be made to the extent of the index cost of acquisition? The answer is no, unless there is tax deducted at source or there is no tax liability, it cannot happen. So this is one part of the question. Now coming to the question which is here, can the bank insist on this 15C and 15CB? Now form 15C and 15CB come thanks to Rule 37BB, which come thanks to 195(6). Now therefore, these forms do not apply to a scenario like this. But practically this has been happening. Practically this has been happening. And on this, I thought before the chairman has the last word in the session, since he is a FEMA expert, this aspect I would request my chairman to answer on the practical aspect.
No, yesterday we were discussing about this question. Sunil was asking, I am a litigation expert. Why have you? Why? No, I understand that because it is a published fact that you are one of the litigation expert in India, judged by the international magazine. So I knew it. So he said, why such a simple question is put to me? Perhaps tax law is not applicable to it. So then he said, then why should I answer? I said, then also you can try and answer. So that's how now he is posing this question to me.
The reason is when the chairman, when they organize the thing, they make us do a lot of work. I said this time let me do some balancing act and let him also do some work.
therefore, see, as you all know, 195(6) applies when one person, payer makes a payment to the recipient, and it is an income of a recipient chargeable to tax, and then whole process will follow. 15CA, 15CB, and the forms and the amendment made thereafter from time to time, that these payments will not be entitled to tax deduction. And there are 33 items also prescribed, where they are also mentioning that all current account transactions as specified in FEMA Schedule 1, 2 and 3 also will qualify for non-deduction of TDS. The question arises that the current account transaction under FEMA can be payment by person to himself or herself, whereas section 195 does not envisage such situation. And therefore the question, how do you apply this? If we recollect, in 2002, CBDT and Reserve Bank together issued a circular, October 2002, circular 2, that if the remittance is to be made by a person to himself or herself outside India, if you are recollect, there is a notification called Notification 13 of FEMA, which allows any non-resident to take a $1 million every year on a net of tax basis. And in light of that, this circular was issued, that if a person wants to take that $1 million net of taxes, then he or she can do so by filing a form and a certificate of a chartered accountant to the effect that this payment is net of taxes under this circular. However, there are a lot of changes in section 195, and probably the bankers and the professionals started issuing this certificate under 15C and CB because banks are asking it. Otherwise, it squarely falls under the remittance of assets, notification number 13 of FEMA as amended to date, and as early as in 2014 also, a circular has been issued by the Reserve Bank of India that the payment of taxes be made in accordance with the circular already issued in 2002. And therefore, the obligation of a chartered accountant is to issue such certificate not of TDS, but whether the payment made is net of taxes. And therefore, your answer will follow. That if, then there was a debate, because Sunil will pose a lot of other questions. So he said, then if investment is not made, would you certify? He said, definitely if investment is not made, is a proposed investment, nobody would certify. And the question was whether if the money is deposited in the deposit scheme of the income tax department prior to the filing of tax return, whether you will certify. He said, of course there won't be any certification because that money can be withdrawn and the tax liability will still come. So the net of taxes would mean the entire amount of taxes has been paid, and therefore the question has been answered by that. Thank you. Thank you, sir. Before yeah, please.
Next question, 11.5. It's one of a practical question, but one we have just discussed. It's an Indian payer paying business income to a foreign recipient, and the foreign recipient has no permanent establishment in India, and therefore the income is not taxable. So question is, what documentation should the payer obtain to support the remittance without tax? And the CA, what should the CA take? Most practical question, I think answer should be that the person has to act bona fide and he has to do his diligence in an impartial manner, like normally one would do for any matter. Now here the recipient is saying that he has got no permanent establishment, so of course he has to obtain a certificate or declaration from him that he has no permanent establishment. That's required in any case. Now additionally he has to do his diligence, and if anything on the record to show that there could be a permanent establishment, then he is put on inquiry, like his website, or his correspondence, or his brochure, or his invoice. Often the invoice will say, that you pay my agent in India, Mr. So-and-so. It says agent in India, but agent can be a permanent establishment. So then they are put on inquiry. But nothing of that type, then with an undertaking can do it. Then there's something, can you inquire, and confirm and then do it. Of course, we can't go to every place and check that there is no permanent solvent. We can't go survey of the whole of India to confirm that. It's not to that extent. But normal diligence is required to be done in this situation. That's the basic reason.
President, I acknowledge the presence of President and the Vice President. Thank you for attending. May I request you to come on the dais? Ajay bhai, there are two chairs.
Clear part. Ex office, if you go to apply for the certificate 197 for the property claim, they are taking a indemnity bond from the seller that you will invest this money within certain time, what put in the bond, and with that they are issuing the lower rate of tax in income tax. And with the indemnity they are doing it. They are not insisting that you first invest and only will give it this and allowing the remittance based on the indemnity.
Because he is certified.
No, yeah. Because the affidavit is given by the client that he will invest in house or in bond within that scheduled time. And certificates are issued by tax department under 187 based on indemnity and affidavit.
0.1%.
There are some more bolder chartered accountants.
Yeah, what is, I didn't hear the question.
No, so he's saying that even if the investment in the house property is not made, you said if the deposit is there, one may still not invest in the house property and the CA may not issue a certificate. He's saying if the client gets an indemnity bond, he will certify.
The tax department is issuing 197.
Yeah, one tax department.
197.
The tax department can issue the certificate because there is a liability to file a tax return thereafter. It is not an assessment.
CA take on that.
It is not an assessment. Non-deduction of TDS certificate is not an assessment. So, and they take an undertaking that you will file the tax return, isn't it? So at the later point of time, the department will always catch them. But chartered accountant may not be able to catch, isn't it? They will go with the two things, non-payment of fees as well as non-payment of taxes. So I leave it to you. I think that should be the approach, probably. What do you say? Thank you.
Conservative.
Thank you, friends. As we have started very well, and everything which starts good has to end well. And I think we ended very well with all the questions being answered by the parent trustees ably and with all nuances. We have completed the session before the time. I think it is ended very well. And all credit goes to all of you because you have participated very well in a very interactive manner. And I thank you all participants. I thank my parent trustees and I thank my all speakers. With that brief closing remark, I request Samaji to propose a very well deserved word of thing. And if before that my president wants to say